So once we purchase an ETF option, we use trade management guidelines to manage the option trade. And the overall goal of the optioneering strategies is to maintain a 3-to-1 or higher profit-to-loss ratio. So that's our overall goal, and in order to achieve that goal, we use our ETF trade management rules to manage the trade once we enter a call option. So this profit-to-loss ratio is calculated by dividing your profits by your losses, and it's a good general overall measure of the risk. So you always want to keep that in mind. When you're trading, you want to maintain at least a 3-to-1 or higher profit-to-loss ratio, and the higher the profit-to-loss ratio, the better. So we'll look at a few examples here. Here's a snapshot of some recent closed trade results for the BRIC ETF. That's symbol is BKF. That's Brazil, Russia, India, and China. And what I did is I went into my online brokerage account and downloaded the closed trades for that I had for BKF. And this column here lists the profits and losses for each trade. So the green, of course, is the profit. The red is the loss right here. So we had total profits on our closed-out trades of $103,000. Our total losses were $11,000. So if you divide the $103,000, if you divide the profits by the total losses, you come up with a profit-to-loss ratio of 8.9. So in this case, we exceeded the 3-to-1 profit-to-loss ratio. So this is just an example of how you calculate that profit-to-loss ratio. So we always want to try to achieve at least a 3-to-1 profit-to-loss ratio. Here's another example. This is the closed-out trades for Home Depot. We had $251,000 in closed-out trades, total losses of $30,000. So if you divide the profits by the losses, we had an 8.1 profit-to-loss ratio. So let's look at the money management rules that we use excuse me, to achieve this 3-to-1 or better profit-to-loss ratio. So our first trade management rule is that we exit losing trades quickly before they turn into large losses. That's very important. You always want to cut your losses short. And then rule number 2 is we don't want to exit winning trades with a small gain. So we cut our losses quickly, and we don't want to exit our winning trades with a small gain. The third rule is we use options to protect our profits when we have a winning trade. So if we have a 30% or higher profit in an option call purchase, then at that point we'll create a spread trade. We either do a debit spread or we do a market neutral spread by using options to help protect those profits. And I'm going to go through those strategies in our next webinar. So we use 2 different types of option spreads to protect our profits whenever we have a 30% profit or higher. Another trade management rule we use is we roll over expiring options to reduce costs and also to reduce the risk of the new option. And that allows us to compound our returns. So at rollover, if the ETF is still on a buy signal, then we'll roll that over into a new option, and we usually go out 1 to 3 months on our option call purchases. So we roll over options, and then when you roll over that profit, it reduces the cost basis and the risk of the new option. And in a lot of cases, we can reduce our risk to 0. The 5th money management rule that we use is we limit the size of our trades to 10% or less of your total portfolio. So that helps you mitigate your losses if you incur a big loss on one of your trades, which can cause your portfolio to incur a big loss. So we want to limit the size of our trades to 10% of the total value of the portfolio. And then our sixth money management rule is that we like to use different types of strategies to diversify our trading. So we use the option purchase strategy, we use spread strategies. We like to diversify our portfolio by using different trading strategies. And we have good success with our ETF option purchase, with the ETF purchases, with ETF debit spreads, and with our profit guard strategies. So the debit spreads and profit guard strategies, we'll cover that in our next webinar. Okay, so we want to exit losing trades quickly before they turn into large losses. With ETF purchase trades, we'll usually exit a trade if we have a 5 to 7% loss. We'll just exit the trade and move on to another opportunity. If we have an ETF option trade, that's more leverage, so we'll exit those trades whenever we get a 15 to 20% loss. We'll simply exit the trade. Now, what I'm displaying here is I went online to our brokerage account and I downloaded our closed trades over a 3-year period and then analyzed the closed trades to see how our money management rules were working. So this is a list of all the trades. Most of these trades were ETF trades. So over a 3-year period, I was able to download all the closed trades and then compile statistics on our closed trades over that 3-year period. And we had total profits of $1,175,000 and total losses of $61,000. Our average profit was 52%. Our average loss was 3%. So what we were doing is we were following these money management rules, and we exited the losing trades quickly. And if I compiled all the losing trades in this last column here, and then our average losing trade was 3.1%, but our average winning trade was 52.5%. So the profit to loss ratio, if you divide the total profits, 1,175,000, by the total losses, you come out to a 19-to-1 profit to loss ratio. So by using these money management rules, we exited our losing trades quickly. We didn't exit our winning trades with a small gain, because otherwise we never would have had an average winning trade of 52%. So this shows you the results of using trade management. It's a very important part of our trading program. And we had 143 winning trades and 61 losing trades. So we had about 70% winning trades, but if you have an average losing trade of 3% and an average winning trade of 52%, you can have 10 losing trades and your portfolio would still profit. So you only need to win on a very small percent of your trades when you use these type of money management rules. So again, we could have 10 or even 15 of these losing trades, and the portfolio would still be profitable because of the size of our average winning trade. So that shows you the value of cutting your losses short and not taking profits, small profits on your winning trades. So if you incur a 20% loss on a trade, on your next trade, you have to have a 25% profit in order to break even. But if you incur a 50% loss on your trade, then it takes 100% return on your next trade just to break even. So just keep that in mind. You don't ever want to let your losing trades grow large, because it's going to take a lot for you to make up for those losses. And if you take a 50% loss, the next trade has to be 100% in order to break even. So how many 100% wins have you had lately? So you don't want to take these big losses, because it's very difficult to make up from them. So if you limit your losses to 20% on an option trade, then you can survive and then move on to another profit opportunity. So losses are just part of the game. We take our losses and then move on to another opportunity. Let's talk about one of our other trade management rules is we roll over expiring options to reduce the cost basis and risk of the new option, and that allows us to compound our return. So if an ETF is still on a buy signal and the trade is profitable, then we'll roll over the option at expiration. And as I said, we usually go out 1 to 3 months with our call option purchases. And when you roll over options, you reduce the risk, and that allows you to compound your return. So let's just look at a few examples. Here's a list of closed out trades. This is for the QQQ. This is the real estate ETF. This is the consumer staples ETF and the utility ETF. So I listed the closed out trades, and this column lists the profit on the option that we closed out. And then we rolled over these trades into a new trade, and in the case of the utility ETF, we closed out the 40 strike call with a $216 profit. So we sold out the April 40 call, and then we bought to open the September 42 call. So we had a $216 profit. The cost of the new call was $690, so that reduced our cost basis from $690 to $474. So we reduced the risk in this example by 31%. Here's another example. This is for the QQQ. We closed out the 95 call with a $509 profit. The cost of the new call was $1288, so that reduced our cost basis from $1288 to $779, so that was a 40% reduction in risk. So a lot of times we will roll over our ETF option trades, and we can reduce our risk all the way to zero and have a negative cost basis, and then when you do that, then of course you're playing with the house's money. So we like to use rollovers to reduce the risk of the new trade. So we have an option trading service where we make recommendations for option purchases. Email alerts are sent out to members with instructions whenever we have a new option trade recommendation, or if we're closing out an existing option trade. A portfolio of option trade recommendations is maintained, and the prices are updated real time so members can track the profit performance of every trade recommendation that we make. So we also have 6 option calculators that for the different optioneering strategies, and those calculators are available to the members of our trading service. And they allow you to calculate the profit potential for 6 different option strategies before you take the trade, which is a very handy thing to have. So our trading service, the current, this shows the current option portfolio as of yesterday. Most of these trades are ETF trades. We have open trade profits as of yesterday of $190,000. The average return for our option trades is 111%. So we maintain an option purchase portfolio and send out alerts whenever we enter a new trade or exit an existing trade. If you're interested in being a member of the option trading service, you can just log on to chuckhughesic.com or call 866-661-5664 if you're interested in becoming a member. And also, if you go onto chuckhughesic.com and just click trade results, you'll get the current trade results for these various option strategies that we trade in the inner circle. So we have a total of 8 different portfolios, and if you click trade results, you'll get the updated trade results for these different portfolios. Here's some recent open trade profit results for the optioneering strategies, and we have $1,082,000 in open trade profits. The first account, which is the larger account, has $901,000 open trade profits, and 14 of these trades are ETFs, 2 are stock trades, and our smaller account has $181,000 in open trade profits.